Hello and welcome to this week's podcast, and thanks for joining me, Michael Hewson, and my good friend Pepstone Senior Market Strategist Michael Brown for our weekly chat about all things financial markets. Nice and sunny out there. I bet you're dying to go out to the pub, mate, now that you've dragged yourself away from Madame Lagarde.
Well, indeed. A very good afternoon to you, mate. Good afternoon to all our listeners. You know full well that you and this podcast and our valued listeners are the only thing standing between me and a nice pint in the sun down by the river. So, as always, I will be fully committed to the cause, but I've also got one eye out the window looking jealously at all the people who...
Yeah, I was going to basically pull those slats apart and look out across to the Rampion wind farm on the south coast, but I'm having to shut them, otherwise I'll get a massive great big load of white light on the side
Well,
of
or
my
you
face.
could end up like me, who has white lights in here and as such has a shiny head as a result of it.
Anyway, this week, it's been a bumper week for earnings. It's been a bumper week for markets. And it's been a bumper week for stupidity from politicians. So where should we start?
It's just been sheer and utter chaos, I think, is probably one of the best ways to describe it. But before we get ourselves in trouble, should we start with the risk warning and then we can really let loose?
Let's do that. Okay, risk warning here. This confirmation is for this content even. Let's start again. This content is for general information purposes only and does not take into account your personal circumstances or your objectives. Nothing in this material is or should be considered to be financial, investment or other advice on which reliance should be placed. The material has not been prepared in accordance with legal requirements designed to promote the independence of investment research. The crude oil prices, Michael, they're up towards $115 a barrel, and yet stock markets, US stock markets anyway, don't appear to care. European markets, on the other hand, are looking slightly more...
Yeah, I think it's been an interesting dynamic because I think very much this time last week it was a case of, on the geopolitical front, no news is good news. Of course, we'd had the ceasefire indefinitely extended and kind of backroom discussions taking place between the US and Iran. That is still the case, it must be said, that the ceasefire is continuing to hold, and we believe that discussions are still taking place, albeit over the phone. But I think we're increasingly, or we have increasingly, as the week has worn on, moved to a landscape where actually maybe no news is not quite so good news anymore. As you said, you know, the Strait of Hormuz is clearly still blocked. Crude benchmarks are grinding slowly but surely higher, you know, a couple of percent a day here and there. It all adds up very, very quickly. And I think we're starting to see that exert a bit of an influence on other asset classes as well. Government bonds have sold off across the board. It's taken the 10-year gilt yield above 5% this week once again. And we've also started to see a little bit of demand coming through for the dollar. So, you know, the US equity market and Wall Street is really the only asset that hasn't kind of reacted to all of that. And I think really that is an earnings story because by and large, we are still going through what is a very, very solid Q1 reporting season. And we'll get our teeth into that in a little while. But as time goes on, I think, you know, it's natural to ask, is the US equity market actually wrong here? And why is the market so willing and so able to ignore the risks that other asset classes are waking up and paying attention to?
Yeah, it's an interesting one. Obviously, it's also been a big week for central banks. We had the Bank of Japan earlier in the week. We've had the Fed last night, had the Bank of England and ECB today. So we're going to talk about that in a little bit. We'll then talk about the pressure on UK gilt markets this week and UK markets in general. And obviously the Bank of England rate decision within that wrapper or context, if you like. Then a big week for earnings. Obviously we were going to talk about BP anyway, but there were a couple of others that caught my eye this week. GSK and AstraZeneca. We'll briefly touch upon them. Whitbread's Premia owner Whitbread this morning announced some job losses, which prompted me to have a little bit of a pop on social media. Can't imagine why. And then obviously we've got Barclays and Lloyds. So we will talk about those numbers. And then obviously the Fab 5 or the Fab 4, because we've got Apple tonight.
Yes.
And
you're desperate for that to catch on, aren't you? Like the number of times you've used that this week.
Mate, you know, Magnificent 7, Fab 5, you know. I'm not going to use Famous 5 because I think that's already trademarked.
I was going to say, we don't want to get lawyers on our case, that's for sure.
No, indeed. Or the Fantastic 4, but, you know, I don't think that's going to catch on either. So, And then obviously so we had Amazon, Meta, Microsoft and Alphabet last night, contrasting share price reactions there. Before we look at next week's payrolls data,
Yes.
in the round on that, UK services PMI, HSBC, latest numbers, next Diageo, Shell, Harbour Energy, IAG, Disney and Uber. Obviously, we won't cover all of that. Certainly
All day.
in terms of the week ahead, because as you say, we'll be there all day. But if you want to read about them, they will be. I've already published it on my Substack, and people can read about obviously those if we don't get to cover everything. So let's start with very briefly the Bank of Japan. We've had potential intervention this morning,
Yes.
and dollar yen's come crashing off 160 quite significantly.
Yes, indeed. Well, I think we should probably still call it potential intervention, but the Japanese press seem to have got some sort of government sources saying that it is actual confirmed intervention now. So, as you say, dollar yen about 5 big figures lower today, Thursday, the 30th of April, as we record. The Bank of Japan not really doing anything, to be completely honest with you. I think it was interesting that the statement and the forecasts were quite hawkish because they actually raised their core CPI forecast for both this year and next year by, I think it was almost 1% for the fiscal year 2026. And bear in mind that that's core. So it excludes energy and it excludes food prices. So headline inflation is going to be even higher. But Governor Ueda at the press conference sounded a little bit more cautious in his language. And he was talking more around two-sided risks and how they would tighten policy, but they also need to consider the growth implications of what's going on in the Middle East. So I think they find themselves in a bit of a muddle, frankly, which actually could well describe most of the G10 central banks we've heard from this week, really.
I'm glad you said that because I was about to make that very same point. I mean, how can you set monetary policy against such an uncertain backdrop? And I think it's very easy for us as analysts to criticise central bankers. And certainly I think your comment on social media this morning about the Bank of England and their various scenarios, I think was a little bit unkind.
Well, let me defend myself then in that case. So
we'll come to that in a minute. But
okay,
let's talk about the Fed last night, because I've got to say that I had to read through some of the headlines, the clickbait headlines, quite a few times, because an 8-4 split, give me a favour. There was no 8-4 split. There was an 11-1 split when it came to holding rates. So this 8-4 split was a little bit of what I call journalistic clickbait. And again, it's one of those things that really, really pisses me off about some of the journalistic standards that we're having to cope with these days.
Yeah, I mean, you spot on that one. For those unaware, of course, the Fed did hold rates steady. What happened was, of the 12 members on the FOMC, 11 of them were in favour of standing pat. It was only Governor Stephen Myron, who's actually now leaving the board, who dissented for a 25 basis point cut. The other 3 of those dissenters that are being talked about in the media, Hammack, Kashkari, and Logan, I think it was. You can correct me if I'm wrong.
Dallas Fed. Yeah.
There we go. They weren't quibbling over the rate decision. They were actually having a debate over the language that was used in the statement. And the thing that they took issue with was the line that said, considering additional adjustments to the Fed funds rate, because they view that as implying an easing bias. And they thought that actually at this point, it's probably best not to include an explicit easing bias in the statement. There was no disagreement over where rates should go. It was merely just a question of forward guidance. And I think you're absolutely right. The media have kind of run away with this and talking about how the FOMC are their most divided since 1992 and all the rest of it. They're not. We have more divided rate decisions than this within the last 12 months, for goodness sake. It's not that big of a deal in my book.
No. At the end of the day, why shouldn't you have a wide range of views? But ultimately, that's all it is. It's a wide range of views, not a split when it comes to setting the headline rate.
Exactly. And actually, in any case, yesterday was Chair Powell's last meeting at the helm. Kevin Warsh has now passed through the Senate Banking Committee. He's almost certain now to be in place by the time of the next FOMC in June. Who knows? The statement could look very, very different depending on how Warsh wants to do communications. It could look very different depending on how the economic outlook has evolved in the 6 weeks between yesterday and the next FOMC discussions. So I really think that, too much weight is being placed on that, to be honest.
The economic outlook actually looks fairly decent, doesn't it, Michael? I mean, weekly jobless claims, lowest since 1969. A
Absolutely.
US economy, US economy, 2% annualized GDP growth, personal income, personal spending, all looking fairly resilient. And yet we have a participation rate that's probably as low as it's been for a while. What to make of it all?
Well, I think this speaks to a couple of things. I think it firstly speaks to the idea that the labour market is still in this kind of no hire, no fire mode where, if you've got a job, the economy is doing really well. And you are, reaping the rewards of what the economy is delivering you. If you haven't got a job, it's at this point very, very difficult to get one because we know that hiring in the private sector outside of healthcare has been quite lackluster and labour demand has been relatively soft. The other thing that I think this tells us is that actually we're seeing an example of this K-shaped economy coming through. And actually one of the things that is underpinning personal consumption and consumer spending is nothing to do with the labour market. It's simply the wealth effect because equity prices are moving higher, asset prices are moving higher, real estate prices are moving higher. That's making people feel rich. It's making people feel better off. And that is underpinning consumer spending to a massive degree. I think there was a stat doing the rounds in terms of 2025. It was something along the lines of the top 20% of income groups in the US underpinned 50% of consumer spending last year, which gives you an idea of almost how kind of lopsided the economy is at the moment.
Hence the K-shape
Exactly that.
metaphor.
Yeah. And over time, that K is, only broadening, it would appear.
Okay. Anything to say about the ECB?
My German fella wasn't there, sadly. We didn't see him, unfortunately. Not really.
So we couldn't do the Raiders of the Lost Ark meme?
No, sadly not. That will have to wait until June. And actually, it seems like the ECB are trying to wait until June as well. Lagarde very much just basically saying we don't have enough information to do anything at the moment, and kind of punting everything to 6 weeks' time when they will hope that there is clarity on the geopolitical front. They'll get another round of forecasts. And I think the door is kind of being pushed open ever so slightly to them raising rates in June. Lagarde did make what seemed like a throwaway line towards the end of the press conference, but was actually somewhat important, where she said that directionally, I think I know where we're heading on rates. But again, so much can change between now and June that I'd really be loath to put too much weight on anything at this point.
Do you really think that much is going to change between now and June, though?
Well, I mean,
household inflation expectations are starting to go higher
in the near term. Longer term are still anchored relatively close to the 2% target. I think one of the issues with central bankers is, I think, we are 2 months into conflict in the Middle East now, effectively 2 months of the Strait of Hormuz being blocked. I would argue it probably becomes a lot easier to look through energy prices if the Strait of Hormuz is open and getting back to normal than if the Strait of Hormuz is still blocked and there is kind of, no end in sight as to when it may become unblocked again, if that makes sense.
It does, but it's not just about energy prices, and I think that's something that people are forgetting. It's about higher component costs from byproducts of liquefied natural gas. It was something that was pointed out, I think, in a couple of the hyperscalers' earnings numbers last night, that component costs had gone up quite a bit. And as a result, I think it was Microsoft who said that they were having to put up their capex by $25 billion to counteract that effect. So
yes.
I don't think markets are pricing that. I think sometimes people look at energy prices and think, well, yeah, that's it. But it's what comes after that.
Yeah, you're absolutely right. Although, to counter that point, all of these are still on the supply side of the economy, to which interest rates have, little to no impact on. But, there we go.
But it's the second and third round effects from that arise from that.
Exactly. But I would argue that, and you're absolutely right, it is the second and the third round effects that policymakers need to focus on. But you're not going to have enough evidence of second round effects emerging by June.
No, I agree.
That's going to take a hell of a long time. If the ECB is sat there going, we'll reassess in June, well, 6 weeks is not long enough to gather information as to the second round effects in terms of, corporate pricing power, in terms of wage bargaining, et cetera, et cetera. You need probably 6 months to work that one out.
So, I mean, I would suggest that we'll probably know coming into Christmas.
Yeah.
And that will, and that could potentially be a bit of a headache.
And actually, to move the conversation onto the BOE, which we'll probably get to in a second, if
No,
you look
move it
at,
on,
well,
because I
there
was
we
going to move
go.
to it anyway.
I
So
mean,
go ahead.
their forecasts, and I'm going to defend myself on this one in a second, but they all actually have inflation peaking right at the back end of this year or at the start of next year, which speaks to the point you were just making.
Peaking where?
Well, good question, Mr. Hewson. This is the bone of contention that I have with the banks. So rather than giving a sort of central scenario or a forecast for the economy, they gave 3 different scenarios. So I won't get into the weeds of what all these scenarios mean, but they're basically different views as to how, firstly, energy prices might evolve, and secondly, how greater potential there is for second round effects to emerge. Now, the nub of this is that depending on which scenario you look at, inflation either peaks as low as 3.5% and then gets back to the 2% target by the end of 2027, or it peaks as high as 6.2% and only comes down to 2.5% by the end of the forecast horizon in 2029. Now, let me be
Mind the gap.
Well, quite. I mean, you probably made quotes as wide as that when you were back in the city back in the day.
No, they're always. That was always a standing joke when I was on a trading floor and you made a price in something like dollar yen or what have you, and the forward desk started shouting out, "Mind the gap."
But you're absolutely right. I mean, that spread is just ridiculous, to be honest with you. Now, let me be clear. I don't envy anyone having to make a macroeconomic forecast right now, because the range of variables is so wide, the uncertainties are so massive, and also this stuff is so fluid. I mean, even today, Brent has traded to 120 and then it was at 110 when I left the desk earlier on. So, it is quite frankly a bit of a futile exercise. But I think that's the reason why I take issue with it. Do the banks seriously think that it is a good use of their staff's time, a good use of market participants' time, and a good signalling mechanism to outline 3 scenarios, each of which have 5 different policy rules attached to them, and arguably none of which will likely come to pass given how volatile and ever-changing the situation is, such that when we get to the June meeting, you'll probably end up with a situation where the governor's going, well, we've sort of got bits of scenario B and we've got a little bit of scenario A and we've had to adapt 3 of these rules. It just turns into a bit of a communication shambles. And I think, they would have almost been better off going, we can't produce a forecast with any great degree of accuracy at this point, and we certainly can't produce one that we can set policy based on.
Yeah, I mean, what's the risk that while the Bank of England may not want to hike, they're forced to because the Fed does and the ECB does?
Well, I think the ECB are a lot closer to raising rates than the Fed. As I really, really struggle to see a Kevin Walsh-led Fed raising rates unless you end up with a kind of post-COVID style inflationary surge. And as we've discussed previously, the policy mix is in a very, very different place to how it was back then. But there is a world in which the BOE do kind of get dragged along with the ECB. I think also if you read, the minutes, obviously Hugh Pill dissented in favour of a rate hike today. Megan Green and Catherine Mann probably aren't far off doing so themselves. So, if you're 6 weeks down the line and energy prices are still elevated, you've probably got 3 votes for a rate hike. It's not the biggest leap in the world. I still think that they would much rather remain
Still
on
a long
hold.
way from 5.
Exactly that. And I think the key takeaway for me from the Bank of England today was Governor Bailey at the press conference was saying that actually in 2 of those 3 scenarios, which I'm going to have to talk about because that's how they want to do things, no matter how stupid I think it is, in 2 of those 3 scenarios, actually what would happen is that the interest rate response is achieved not by delivering policy tightening, but simply by not cutting rates as they thought they would in February. So what Bailey is essentially saying there is that in scenario A and scenario B, they would just stay on hold. So again, which of these scenarios comes to pass is anyone's guess. But I think the bank, if they have any choice in the matter, would rather just sit there and stand pat than actually deliver another rate hike, because they're already in restrictive territory with bank rate at 3.75%. The ECB are at neutral. That's the other difference.
Okay, here's a question for you. Does it really matter where bank rate is? Given the fact that since March this year, UK 5-year yields have gone from 3.75% to 4.5%.
Yes. I mean,
well, and I know, in terms of, obviously in terms of mortgage products, it matters. And, all the various interest rate products that are priced off bank rate. But you know, UK fiscal policy is making interest rates much tighter than they need to be anyway.
Yeah. And I think this is the issue here in the UK. We are running a policy mix that is very, 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 very loose on the fiscal side and might
Yeah.
become even looser on the fiscal side, depending on what happens after the 7th of May and whether or not Rachel Reeves is thrown under a proverbial bus or even Keir Starmer faces a leadership challenge. And I think you're absolutely right. It does lead to monetary policy having to run a little bit tighter than it otherwise would. And it also means that gilts, in terms of a yield, are trading at a premium to other developed market bonds that really shouldn't be there. If you think about fundamentally, should there be a premium for a 10-year gilt yield over a 10-year treasury yield? No, not really. The US and the UK economy are relatively similar. Over the long run, the dynamics of those economies are relatively similar. The problem is, over the last decade, we've run very loose fiscal policy and we've had inflation running above target. And that means that investors are demanding a yield premium for it.
Well, I think a classic case in point is the UK 10-year gilt yield is 5% and the US 30-year treasury yield is 5%.
Yeah, exactly that. And of course, certainly the 10-year gilt yield is only going one way at the minute, and that ain't down.
Well, it's come down a little bit today, and I think that's largely as a consequence of the fact that the markets have priced out a couple of rate hikes this year. But that's very much a short-term effect. As you say, the direction of travel is very much to the upside. We've obviously got the May elections coming up next week. I haven't written about them in my week ahead because I just wanted to keep my blood pressure at a fairly even level. But, the 30-year yield, highest since 1998. And I think the prospect of Starmer and Reeves, awful as they are, being replaced by someone equally as bad or worse, I don't know about a moron premium. I think we've got more of a retard premium.
Jesus Christ. We're going to get cancelled for that one, I can tell you right now. But I think you are probably... Well, no, I think you're right.
Retard, if you look up the dictionary definition of retard, it's to slow down.
Well, I'm not sure the economy can slow down much more. It's going to bloody reverse if we did that. But I think you are right. And I think this is, we've spoken about this on the podcast before. We may as well cover it next week because that will be nearer the election. But, the UK investors are dealing with political uncertainty, which markets hate at any point. Markets hate political uncertainty because you can't price the future. But at the same time, you've got a degree of certainty on the fiscal front, which sounds really weird. Why would fiscal certainty be a bad thing? Well, it's a bad thing because it's certainty of a worse outlook than we have right now, because we know that whoever comes in to replace Rachel Reeves is likely to adopt a much, much looser stance and much more left-wing policies. And actually, in many ways, I don't want to get into the weeds on this too much, there are signs that Reeves has already lost control, because all of these trial balloons that were doing the rounds this week about rent controls, I mean, God help us.
The thing is, apparently it was proposed by one of our backbench MPs who used to be an FT journalist.
And who sources say someone thought could be a good chancellor.
Yeah.
So a bit of an inside joke there, apologies. But yeah, I mean, that's just utter nonsense. That would simply result in the supply of homes available to rent falling off a cliff, and it would have completely the opposite of the intended effect.
Another so-called PPE graduate has absolutely no idea about the E component of that PPE qualification.
Well, I'm not sure they have any idea about the P or the other P, to be completely honest, but we can leave that one for another time.
Yeah, I mean, talk about dumb and dumber. Anyway, let's move away. And let's look at the earnings this week, because by and large, I haven't really found much to really disappoint, but some of the share price reactions have been quite stark. I mean, GSK and AstraZeneca. GSK's share price fell around about 5 or 6%. The numbers were solid. Sales increased 5% to 7.6 billion. Oncology did well. The only weak spot was general medicines business, where sales fell 6%. So maybe, I think there's concern about growth area there. And they did reiterate their guidance for 2026.
Yeah, I guess the other thing to consider on that front is not only the concern that you mentioned, but also input costs. We know that is going to hit the pharma sector, hit chemicals, et cetera. Are market participants just kind of bracing for that? Yes, they've reiterated their guidance. Are investors becoming perhaps a little bit more skeptical as to whether or not they're actually going to achieve that guidance is the other question.
AstraZeneca also decent set of numbers. Q1 beating profit expectations, oncology sales up 16%, rare disease sales up 15%. Outlook unchanged, annual revenue target of $80 billion by 2030. And there was some good news for the UK. Apparently they're going to spend $300 million in their Cambridge R&D operation. So I suppose that's something. Still doesn't change the fact that they pulled out of the Speak operation and have no intention of revisiting that.
Well, no, exactly. And we won't need to go over that ground again, but who can blame them on that front? But yeah, at least it's something. Whether it's the start of a further series of investments, only time will tell, but we can keep our fingers crossed on that front.
Yeah, slim pickings, I think, in terms of taking the bones out of. And Whitbread, Premia in owner Whitbread. Again, the shares were down 16%. They've recovered a little bit since then. They're now down around about 4%.
Yeah.
But job losses, 3,800. And the reason why, well, I'll let you tell people the reason why.
No, go on. I don't want to steal your thunder.
No, you don't have to.
No, go on. You've written it.
Basically, 110, they're going to sell off their restaurants, 197 of them, 110 of them over the next 2 years, resulting in 3,800 job losses because of higher business rates, higher national insurance. So slow hand clap for Rachel Reeves.
Yeah, exactly. Well done, Rach, for shooting yourself in the foot yet again. As you rightly put in your note, that is going to it's going to chop about 150 million off revenue because obviously they're losing a huge chunk of their business. It also makes them considerably less diversified because they're going to be focusing primarily on the accommodation side of things. So it's an interesting one because when you look at it, and I mean, the stock is trading basically at 5.5 year lows. I think we're back where we were sort of during the pandemic, or at least we were earlier on. You kind of go, well, actually, the world isn't locked down. People can travel. Why is it there? Well, it's there because they've just scythed out a huge chunk of their business, which is simply unaffordable for them to run anymore.
Yeah, I mean, and again, they just completed their recent buyback. And again, it leads me to question why they would do this because it hasn't added any shareholder value whatsoever.
Well, certainly not now.
No, but I mean, even then, they must have seen this coming.
Yeah.
Any management that's on the ball will know that if you're a consumer discretionary, even at the budget end of the market, you must know that at some point your costs are going to go up. I mean, the budget was in November, for crying out loud.
Yeah, it shouldn't exactly come as a surprise. And actually, one of the things that I've been talking about for a while now is that actually, I think it is that budget end of the consumer discretionary market in terms of hospitality that probably is going to struggle more than other ends of the market. Because actually, if people are going to be going out to eat or going out for drinks, they're probably, and times are tough and belts are being tightened, they're going to go out less frequently, firstly, but they're probably also going to go somewhere that they would perceive as nicer or higher end in the market to kind of treat themselves and make the most of it when they do actually go out. It's like the sort of whole casual dining sector years ago, that ended up just kind of completely dying because people weren't engaging with that style of restaurant. And I think this is, kind of what we're seeing with Whitbread as well.
Yeah, indeed. It's also selling off £1.5 billion of its property to fund future expansion, as well as cutting spending on new projects. So it's cutting back on essentially investing in future capacity.
Yes.
Which again speaks to the economic outlook. I'm a big fan of Premier, and I'm staying in one tomorrow night.
Yeah,
because I'm travelling up to Scotland.
I've always been very happy with them. In fact, I used to spend 3 or 4 nights a month in one when I was doing my my MBA back in the day, and never had any complaints whatsoever. You know what you're going to get, but the business does not seem in great shape at this moment in time. So,
well, it's the German business is doing better. It's started to turn a profit, but it still makes up a very, very small part of their overall annual revenue, or quarterly revenue. So, while the German business is growing, on the plus side, bookings are ahead of last year. So perhaps people are choosing to stay at home, and perhaps as a result of events in the Middle East, people are thinking about staying at home, expensive though it may be, because at least they can be guaranteed to be able to get back.
Yeah, exactly. And also people are, as you say, just becoming potentially a little bit more risk averse in light of the global environment, and who can blame them?
Okay, let's talk about BP. Decent set of results, all driven by their gas trading division. And prompting Moron Miliband to tweet something economically illiterate.
I mean, yeah, where the hell do you even start with that? I think I would actually argue the bigger story here is the government side of things as opposed to anything BP reported, because if you listen to what Ed Miliband's got to say and then what Keir Starmer was saying yesterday as well, because he was kind of doubling down on this whole idea of a windfall tax, we seem to be at a point where the government are now deciding how much profit a business in the UK can make, which I think in anyone's book is slightly outrageous, and also in anyone's book, if you are an international investor looking at that, doesn't exactly make the UK a welcoming and conducive environment. You know, come here, invest in the UK, do really well, grow your business, but don't do too well because we'll take a little bit more in tax if you do. I mean, what sort of a message does that send, for goodness sake?
Well, it just means that they'll get less tax.
Yeah,
Because
exactly.
people won't invest in the UK.
And the economy will grow at a much slower pace. And particularly with, BP are an energy company, with risk of stating the obvious, we need investment in energy here in the UK, which we're not going to get if you pursue economically illiterate crises like this. It's utterly moronic.
Of course, it raises another question. Could BP and Shell move their listings away from the UK? I mean, let's face it. Why would you keep them here?
Why wouldn't you? Why would you not? Because, this is, and this isn't a new thing. This sort of so-called windfall tax has been in place for 3 or 4 years now on these companies. And actually, it's being raised again. We had that news last week. Surely it's going to get to a tipping point where both of these oil majors just turn around and go, do you know what, we've had enough. We're going to move our listing. We're going to move our corporate headquarters. There's nothing that's actually tying them here. And if anything, the government are, short of keeping them around, are actively pushing them away at this moment in time.
Yeah, indeed. I mean, it was a fairly decent share price reaction. So fairly decent. We haven't gone above the highs that we saw in mid-March. And I think one of the reasons for that was because when you look under the hood, away from obviously the decent results that we saw in this particular quarter, there were significant weak spots. And I think Meg O'Neill does have her work cut out. The company's net debt went up, despite the fact that the buyback's been binned, back to $25.3 billion. Operating cash flow slipped back, and other operating costs rose by 46%. So, there were still challenges. Challenges.
Absolutely. And as you say, she has got her work cut out. But having said that, she does seem to be saying all of the right things, moving them back to focusing solely on oil and gas, et cetera, et cetera. And none of that is going to happen overnight. So, yes, it is absolutely a difficult situation for Meg O'Neill to come into. But again, she will have known that. I'm not sure this is telling the market much new either. So, it's maybe a little bit of an overreaction.
I'll be interested to see whether or not they're still able to reduce their net debt to between $14 and $18 billion by next year.
It's quite an aggressive target.
It's quite an aggressive target now, given the fact that the debt levels have gone up.
Yeah,
but,
exactly that.
Judging by the share price reaction, I think the markets still think that it's feasible. And I suppose with oil prices and gas prices at current levels, there's no reason to suppose that once they get their house in order, so to speak,
until Red Ed comes along.
But then again, that would just speed up the flight out of the UK.
Yeah, absolutely.
Okay,
banks.
Yeah, Barclays, Lloyds. Barclays disappointed on
So
FIC.
Barclays worries me. And actually, not just Barclays, European banks worry me a little bit. Crédit Agricole, Santander. You look at Q1. Q1 was a very, very volatile quarter, as we know, certainly March. US banks, as we covered on the podcast a couple of weeks ago, do go back and listen to that if you haven't already, had an absolutely stellar Q1. The only sort of blot on the copybook in terms of Q1 figures from US banks was Goldman's fixed income revenue, and it turned out they just got caught offside on a load of short-term interest rate bets, which explained that away. Why on earth have European banks underperformed so significantly relative to their US peers in terms of trading revenue? That should have been underpinning things. That should have been really propping things up over the last 3 months. Not necessarily at Lloyds because they're much more consumer focused, but certainly at someone like Barclays, and it simply hasn't happened. What's gone wrong?
Yeah, fixed income was flat.
Yeah.
Equities had a decent quarter, 16% increase in income to 1.1 billion, but FIC was really disappointing. and not really apparent why.
No. And you sort of ask yourself the question, you scratch your head a little bit. If you can't make trading revenue in a market like that, when can you make decent trading revenue?
Well, indeed. As I say, there wasn't much of a reaction to the Barclays. Lloyds, on the other hand, again, slightly disappointing. Calls, I think, will grow for a windfall tax on bank profits. Spare us. It's almost like a knee-jerk reaction, as you say. If you make too much money, there's this sort of politics of envy,
But I mean, we've already got the bank surcharge, for God's sake. Why do we need another windfall tax?
You don't. But unfortunately, it's red meat to the economic illiterates that tend to follow them.
Yeah, I think you're probably right on that one.
But is it economically credible? Is it economically literate? No. I mean, could Lloyds perhaps narrow the margin between the amount of money that they lend to clients and the amount they pay on deposit? Do they take liberties when it comes to the deposit rates? Yeah, well, they do. But shop around.
Doesn't. Exactly.
Yeah. And shop around.
Yeah, and as you say, shop around, because that's how a market works. You've got 5 or 6 high street banks. You've got goodness only knows how many other regulated banking institutions in the UK these days. Those competitive forces drive better outcomes for the customer, because people can shop around. I bank with NatWest. No one is forcing me to keep my money with NatWest. I could wake up tomorrow morning and go, actually, I'll become a Lloyds customer because they offer me a better deposit rate, or I'll become a Barclays customer for whatever reason. That freedom of choice is what fosters a better market and a more competitive industry, not taxing these companies to high heaven.
Having moved my bank account on one occasion, it is an absolute pain in the backside, because you've got to change all your standing orders, direct debits, and everything else. But what I would suggest you do is, even if you keep your current account at one particular bank, you can shop around and have different deposit accounts or savings accounts at different banks, and it certainly pays to diversify your risk when it comes to banks, because obviously there is a limit to the amount of savings you can keep with any one bank.
Yeah.
And if you spread that risk around, then obviously it means that if one bank fails, not all your eggs in one basket. But that's just sensible risk management.
Exactly. Although I think I will stress, and I'm sure I speak for you here, the UK banks do appear very, very resilient, and we're not suggesting that any of them are on the brink of falling over or anything like that.
No, they're not. I mean, they're extremely resilient, and probably as resilient as they've been since before 2008.
Yeah,
so,
absolutely.
I don't think there's any danger, touch wood, of any of them falling over.
We've jinxed that, haven't we?
Famous last words.
Right, moving on swiftly. Should we do all the Fab Five or the Fantastic Four,
let's do the Fab
hyperscalers, whatever we're calling them now?
Let's do them in the round, because I think
that's easier.
It's easier that way. Amazon and Alphabet, really, really strong numbers. Share price on both gone to new record highs.
Mm-hmm.
Although Amazon is starting to give back some of that right now. But CapEx still looking really strong. I mean, I think compare and contrast the impact of Alphabet and Amazon at the end of Q4 and Alphabet and Amazon now. They haven't. The share price sold off aggressively in Q4. Now they're both high.
They are, and I think one of the reasons for that is because everyone's getting very, very enthusiastic and perhaps a little euphoric over the whole idea of AI once again. I think that actually the bigger contrast is Amazon, Alphabet, Meta all raised their CapEx guidance last night. Alphabet stock is up 5%. Amazon stock was up; it's trimming those gains. Meta stock is down 10%. And that, I think, is really quite telling, because for me, the message the market is sending there is more CapEx is okay if you're monetizing it, if you're generating revenue from this capital expenditure, which clearly, if you look at the sales growth that we're seeing, Google are doing, or Alphabet are doing, Amazon are doing. Meta aren't doing that, because all of this is internalized. It's building the metaverse. It's building their own models. They're not actually selling this as a service or as a product. And I think the market is rightly taking a little bit of a dim view of that, effectively saying, Mark Zuckerberg, fine, you want to spend more money, but can you please give us some idea of what you're spending this on and when the hell we're going to see a return on this? And it almost feels like we say that about Meta every quarter at this point.
It does. I think one of the things that struck me about the numbers was that there was a drop-off in daily active users for the family of
of apps.
Family of apps, yeah. Even though guidance, they still expect chunky revenues of between $58 and $61 billion. I thought it was interesting that Microsoft also announced a capex rise, but that was largely due to higher component costs. But
Yes.
they sold off. But surely those same component costs are going to be the same for Amazon.
Well, they're
and
all buying the
Alphabet.
same stuff from the same
Yeah,
suppliers, aren't
exactly.
they? So you'd certainly imagine so. Yeah, I
Do
did
you
find
think
that a little bit odd.
Do you think the OpenAI thing is basically weighing on Microsoft and the fact that they don't have any other big clients?
It could well be. And of course, what you allude to there is the Wall Street Journal reporting we had earlier in the week that OpenAI last year missed various internal user growth and revenue targets, and they're also missing them this year as well. And I think you're right. Microsoft, one of the things Microsoft did, and at the time we all thought it was a masterstroke. Now it's maybe not looking like quite as much of a masterstroke, is heavily, heavily concentrate themselves to OpenAI and to ChatGPT, whereas a lot of the others have become more diversified, and actually that diversification is bearing a little bit more fruit now, it seems.
Yeah, I mean, Microsoft saw a 39% increase in Azure and other cloud services. Google Cloud, right, revenues surged 63% from 12.2 billion to $20 billion. So that infrastructure spend does appear to be generating revenues. And the big question is whether or not they can continue that explosive growth in their cloud business.
Yeah, exactly that. And ultimately, again, that is the key question with these hyperscalers. They are growing at such a breakneck pace. Can they keep it up? Thus far, yes, is the answer. Is the resounding answer to that question. We will come back this time in 3 months and see whether we're saying the same thing.
I think the shoe that hasn't dropped on that is the energy costs that these companies will eventually end up having to pay. And you can talk about the US being a net energy exporter, but you only have to look at the prices at the pump in the US to know they're not immune to what's happening in the Gulf. No matter how much President Trump would like to say that they are, they're not.
No, of course not. And we all know that. I mean, even today, I think it was California. Gasoline is now $6 a gallon. And, I think the national average is probably not far off $5 now.
Well, it's about $4. The reason California pays a lot more than other US states is because of green surcharges on the price of a gallon in California.
Yeah,
I know that because I'm a regular visitor there. We went twice last year, and
just as well.
My wife's brother lives there, so we get first-hand knowledge of some of the stupid taxes that get levied on gasoline. Okay, so that's this week. Let's move on to the week ahead.
Indeed.
Got non-farm payrolls. In the context of what I would call some very flaky numbers, we saw a really bad number in January. We saw a rebound in February. Or was it the other one? No, it was
the other way around. Jan was fine. Feb was negative. March was a rebound.
Yeah. So we've got April. But if you look at the ADP jobs report, that's been much less volatile. 41,000, 11,000, 66 and 62. Growth every month since November. The US economy has bounced back in the first quarter. US companies are investing $700 billion worth of capex. And the labour market, while looking fairly resilient, I would suggest that's probably why the Fed was fairly, okay, we'll wait and see. So what are we expecting for payrolls next week?
Well, I have no idea because the consensus isn't out yet, and I haven't blindfolded myself and thrown darts at a dartboard to come up with my own guess. The one thing I would say about the jobs report, though, is I think that for years we've all focused on the headline payrolls print, and rightly so. But I think increasingly, because the break-even rate of payrolls is so low in terms of, the labor supply in the US just isn't changing. It's basically flat because of net immigration being at zero, which means the economy doesn't actually need to add really any jobs every month in order for unemployment to hold steady. And that creates a lot of volatility in terms of headline payrolls, as you rightly alluded to, given how the methodology works, et cetera, et cetera. I think the key focus is the household survey. Where's unemployment? Where's labor force participation? That's the key thing to watch, because last time out, unemployment came down to 4.3 3%, but participation also fell to 61.9%. So yes, unemployment was down, but it was down because people weren't looking for a job. I think that's the
That
key
sounds
thing.
familiar.
Well, it sounds very familiar, doesn't it? But I think that's the key part of the survey to watch to me. But all that said, is this non-farm payrolls number going to change what the Fed do in June? Of course it isn't.
I mean, weekly jobless claims, 189,000.
Mm.
I mean, obviously, that's not going to be the payrolls number or the payrolls week.
I do.
It
Can I tell
points,
you? I do have a story about that, actually.
okay. But
So
it does point to a direction of travel, though, doesn't it?
it does indeed. It's a very, very strong print. I'll keep this brief, but of course, as every trading sales floor does, we run a payroll sweepstake on the Payrolls Friday. One of our risk guys comes in on the Friday morning, all harried, give us a guess, give us a guess, give us a guess, looks at his terminal, writes down a number. I look at the number and go, are you bloody well sure? 202,000 was his guess. Where'd you get that from, mate? Oh, I looked at the wrong thing. I put down the consensus for jobless claims, not payrolls. Anyway, roll forward 5 hours. Guess who's taking home a pot of cash because he's been nearest the pin? So turns out guessing the initial jobless claims number might get you the payrolls win as well.
Oh, right. So was that the day before?
It was, yeah.
It was the day before. So jobless claims number next Thursday, guys and girls. That's going to be your payrolls number.
Indeed, there's the secret sauce. Oh dear.
But yeah, I mean, I think if you put two and two together, why is the UK economy stagnating and why is the US economy growing? It's called business capex.
Yeah,
because it trickles down.
exactly.
So how much capex have UK companies put into the economy this year? Well, I was just looking at an EY Item Club survey, and they forecast that UK business investment will shrink by 0.2% in 2026.
Yeah,
So,
I mean, says it all.
So the US is basically, US companies are throwing money, and overseas companies. I mean, AstraZeneca said they're going to throw in $50 billion worth of investment into the US. And our government is disincentivizing companies doing the same thing. It's almost, I don't know, words fail me.
Yeah,
Mind-numbingly stupid.
I completely agree with you. Yeah, the UK data calendar is relatively light next week. I think we do get services PMIs. It is final data, so it probably won't be revised especially much from the prior 52. But that was driven largely, if not solely, by a lot of people front running, basically saying, we know higher prices are on the horizon. We know supply disruption could be on the horizon. Let's get our orders in now rather than waiting. So as a result of that, it pushed the activity metric a little bit higher. We also know that simply is not going to be sustained. So I don't think there's much we can glean from that report.
No, indeed. Okay, so we've got HSBC next week, 5th of May. Again, I think if you take the US banks as a benchmark, then you would expect similarly strong performance from HSBC. But again, one of the things they did in their last numbers was they took an impairment on the Bank of Communications stake, which obviously they bought the rest of. And how's the China business doing? How's the Greater China business doing? I think that's going to be, also something to watch out for. But certainly, I think all the big banks, certainly as far as the UK is concerned, I don't think I have too many concerns about them. I think the big question for me is whether or not it can take out those highs that we saw in February, around about 1400 p, 1400p.
Yep.
But certainly momentum does appear to be in its favour, and the shares are quite strongly up today at the moment. I say strongly, they're about 1.6%.
And the read across from peers is relatively positive. So, fingers crossed bodes well.
Yeah. We've got AIG, International British Airways owner. So front and centre, obviously EasyJet reported concerns about shortages of jet fuel. Again, I think we've recovered from the 9 months lows of AIG that we saw in March. I think the big question for me is, are they going to be looking at cutting flights, particularly as we hit peak holiday season? The shares look vulnerable at the moment. They've rolled over from where they were earlier this month, and we could well see a retest of those lows in March if we don't get anything particularly encouraging from them in their update on the 8th of May. I think it's on Friday, I believe.
Yes, I think it is. And I think you're absolutely right. It is, what is IAG's reaction to higher jet fuel costs? That's the question the market wants answered, and hopefully we get an answer to it.
Yeah. Harbour Energy, I just want to put this out there. Their last set of full year numbers back in February, March, they posted profits of $2.8 billion, over double that of 2024, when they returned profits of $1.2 billion. After tax, losses almost doubled from minus 93 million to 182 million, and its effective tax rate came in at 106% because of the windfall tax.
I mean, again, I don't want to flog a proverbial dead horse here, but who the hell is going to invest when you're going to pay a 106% marginal tax rate? Even just saying that out loud, I feel like I sound ridiculous even just saying it,
I know. I mean, they want to open up North Sea production. Okay, fine. If you do, and you manage to get Miliband to back down, you need to change the windfall tax. You need to encourage investment, because you can say, okay, we're going to grant these licenses. Fine, grant them. But who's going to spend the money and basically getting that oil and gas out? I wouldn't.
No, nor would I.
Anyway, they're due on the 7th, so it'll be interesting. And it's not for nothing have they basically been diversifying away from the UK. Wintershall Day acquisition bearing fruit, revenues up to 10.3 billion from 6.4. And all of that was down to the purchase of that particular set of assets. And they're opening up markets in Mexico and Argentina, because essentially they can't make it pay in the UK. And who can blame them?
That.
Anyway, we're going to finish off with Disney and Uber.
Yep.
Disney, where are you? Let's look at my Disney chart.
Well, bearing in mind you sent me a picture earlier on of your incredibly neatly formatted watch list, you should have it in front of you in a flash.
I do, but for some reason, because the internet connection's a little bit flaky, I actually can't show the charts.
Right.
Because for some reason it's chugging.
Yeah.
So
well, just imagine, ladies and gents, Disney, after their Q1 results, the line went lower, and since then...
Yeah. And since then, they found a base at around about $92 after dropping from 116. They've rebounded some of that, and they're back above 100. But I think with the World Cup this year in the US, I think the thing for me, for Disney, is, given the Trump's administration aversion to tourists, will these numbers at the parks take a significant hit as a result of that? And with the World Cup as well.
Yeah, I mean, I
being
think
so expensive,
it's almost a triple whammy in many ways, because one, you've got this administration aversion to tourists from abroad coming in, which is obviously going to be a hit. Secondly, you've got the World Cup, which is going on, which, in and of itself, the fact that the World Cup is happening means that there will be less people going to Disney parks and other attractions of that ilk, just because there are other things to do, and almost a kind of once in a lifetime thing to do as well. And thirdly, as you alluded to, not only is the World Cup going on, but it's so damn expensive. If you look at tickets, it's $300 for the cheapest ticket for a group game that no one cares about, and then transport and all the rest of it. Consumers just aren't going to have the disposable income and the cash on hand to go, I'll go to the World Cup and I'll go to a Disney park. So I do think there's quite a lot of downside risk there, actually.
Well, there's the flights as well. The flights are more expensive.
Yeah, if you can get a flight.
Yeah. And not cancelled.
Yeah, absolutely.
So, I mean, the guidance was soft, and that was largely as a result. That was the reason behind the sell-off. I fear that there could be more downside here, particularly if they guide lower for Q3. So it'll be interesting to see whether or not how they feel about the outlook going forward. The entertainment division does appear to be doing okay, but it really is domestic parks and experiences that will determine whether or not we see a rebound in the share price back to the levels we saw at the end of last year and the beginning of this.
Yeah, absolutely.
And we've got Uber. I won't cover that. You can read about it on the Substack. So unless you've got some comments on it.
No, absolutely not. To be honest, okay. I'd totally forgotten Uber were reporting until I was reading these notes about an hour ago. So no, I don't have any pertinent insight on that whatsoever, I'm afraid.
Okay, cool. Right. Well, next week I'll be doing the podcast from Scotland. So
in a kilt?
but we'll certainly have plenty of things to talk about. And obviously, I think it's the May elections next Thursday as well. So
Yes, it is.
maybe there'll be something to talk about from the UK side of things, on the basis of perhaps early exit polls. I don't know. We'll have to wait and see.
Indeed. Time will tell. But good to chat as always, mate, and I'll see you next week.
Always a pleasure. Have a great bank holiday weekend, and speak to you all same time, same place next week.
See you later.